Hi, welcome back to Melone Hatley's podcast. I now pronounce you divorce. Today we are joined by special guest René Soliz, and we have Valerie Fisher with us, was our litigation attorney from our San Antonio office. So both of you, thank you so much for joining us today. Renee, if you don't mind, just introduce yourself to everyone, kind of a little bit about yourself, who you're with, and then we'll get started.
Yeah, absolutely. So my name is René Soliz. I'm the founder and owner of Freedom Wealth. I've been in the financial industry going on 13 years now. And so I help a lot of people with a lot of different things. People have a retirement planning, they have education planning, possible divorce, estate planning considerations, taxation considerations, all those types of things. So I usually help high net worth individuals. I help families. I help a lot of veterans and business owners with planning for the future. And so I always plan for the worst, hope for the best, and it's going to be somewhere in between.
Wonderful. And I know we have a lot of questions that we've been talking about that we want to go over in this podcast. So I guess we'll kick it off with what tax issues should someone think about before their divorce is finalized?
Well, when you are together as a couple, you get all kinds of tax benefits. You get higher income limits with tax brackets. You get better capital gains consideration. And so, when somebody is thinking about getting divorced, you're basically going to be cutting those tax brackets in half, right? So, if you have a high earning spouse and a non earning spouse, the high earning spouse all of a sudden is in tax brackets that they weren't in before. So something, very much to consider. Also, you think about if you have kids, who's going to claim the kids on the tax return? How do account divisions work with capital gains, with taxation, things of that nature? And then what type of tax credits you might be losing in doing the split. So there's so many things that you need to think about as far as income goes, as far as, realigning your goals to a single person now instead of a joint purpose. And so just a lot of things to think about.
You brought up an interesting point. How does the filing status affect what you were just talking about?
So usually a couple will file married filing jointly, and that either goes to single or filing head of household, whoever's going to have the majority of the kids. And so when you look at if somebody was making $150,000 as a household, and you have one predominantly earning spouse and one maybe not earning spouse, you go from a 22% tax bracket, you could be upwards of the 24, even 30% tax bracket for that single person. And then you start thinking about, well, if there's going to be alimony, if there's going to be child support, how that all becomes taxable. And then whoever has the kids will be able to claim the tax credits on the kids, whoever has them the longer period of time throughout the year. And so, the higher earning spouse, if you have joint, each spouse is earning about the same, your tax brackets are still going to go up. You still got to figure out how we're going to divide the kids. You got to figure out, if we're dividing assets, is these assets going to add to my income, or is it going to still be tax favorable, tax deferred, things of that nature. And so, just a lot of things that you need to talk about or think about before, it all comes down the pipe.
What are some common mistakes that maybe people make while going through a divorce when we're talking about taxes?
Yeah, so the first thing is you don't adjust your withholding. You may still be thinking that, hey, if I had three kids, I have three exemptions, and so on my W-4, I have not been withholding a whole bunch of tax because I'm planning on getting those child tax credits. Also preparing for that higher income tax bracket. You may have said, hey, my tax liability may have been, 10, 15 grand, and now it might be 30 grand, it might be 25 grand. And so you need to think about what your actual tax liability is going to be and then start withholding to that. One thing that I see a lot is people, when they're going through a divorce, they don't think about the renaming beneficiaries on their accounts. I've had a few clients that have been married and divorced several times, and they still had the first ex-wife or first spouse on their life insurance, on their retirement accounts that they didn't ever get changed. And if they were to pass away, that's who's getting the money. You can't change it after the fact. type thing. So make sure that when you go through everything, you're looking at all of your financial aspects, names on accounts, how things are titled, tax withholding. You gotta think about tax basis or cost basis whenever you're taking assets. So retirement accounts have a certain tax liability to them, or they may not. Roths do not have a tax liability. Traditional IRAs or traditional 401ks do have a tax liability. If they had things in a joint account, you have capital gains that you need to worry about. If we're thinking about trading out the house or who gets the house, you have cost basis and taxes associated with capital gains if you were to sell that house at a point in time. The other thing that people think is all assets have the same kind of tax value. They don't. And so when you're planning that split, you need to think about, well, how is this going to affect tax liability? How is this account going to affect tax liability? Uh, so I see that quite often. The other thing that I see too is I see both parents trying to claim the kids, which is a big no-no. In the IRS's mind, you have a custodial parent. You have a parent that is going to be, 50% of the time or 50.1% of the time have the kids the majority of the time. Those are the ones that would be able to claim the parents. And so, talking through that divorce of, hey, if I am a high income earning person, um, am I going to have the kids as a tax credit or am I not going to have the kids? And so it all comes to talking beforehand. If you can be cordial with that process, it helps out quite a bit. But kind of, forgetting all those things, it can leave you in a big tax mess at the end of the year.
Hmm. One of the things that Valerie and I were talking about is kind of like a post-divorce financial reset. And what are some of the moves that someone should make as soon as a divorce is finalized from a tax planning perspective?
Uh, from a tax planning perspective, you got to relook at everything. You got to look at your income. You got to look at what's going to be coming in, and then in the wake of a divorce, you're starting from scratch again. You got to figure out, what is my needs based budget? What am I going to, do for housing, for food, kid support? What all that kind of looks like. And so in doing so, you start thinking about again the tax credits I'm going to have, the income brackets that I'm going to be in. A lot of times is just surviving. Some spouses or ex-spouses may pull from retirement accounts to help themselves, stay afloat. And so just kind of being aware of the tax consequences of that. So it's always helpful to talk to somebody who's in that sphere. I always talk about if you can prevent something with an ounce of cure, it helps with a pound of, trying to fix it later type thing. So, it's all about reorganizing yourself to you are now the provider of your own goals, right? You are making your own future. You can't rely on somebody else like you were or you may have in the past. And so trying to get yourself back online, trying to get yourself straight of here's my needs. And once I hit my needs, now I'm going to work down to what are my wants? What are my retirement savings goals now for myself? What does Social Security look like now for me? And again, thinking about what's the tax consequences going to be of that, especially of a maybe higher earning income spouse. You need to know what that is going to cost in the long term through this divorce or through this split.
How should newly single parents adjust their withholdings? I feel just in my own experience and talk with clients after divorce, there's always seems to be a question that comes up.
hmm So that is based on the W-4, right? If they're working as a W-2 employee, they're working for a company. The form that they would fill out is the W-4. It basically says what is your planned income for the year, and then also what are your child exemptions that you're planning on having. And so, if you had one kid, two kids, three kids, each kid comes with a tax credit. It's like $2,200 for each kid. You could get all the way up to $6,000 with the kids that you have. And so looking at what your exemptions are going to be will determine what your withholding is going to be. Looking at what tax bracket am I going to be in, minus my standard deduction, minus these tax credits, what's my actual tax liability, and therefore what should I withhold? type thing, because you don't want to over withhold and then you're really struggling to try and rebalance yourself with unnecessary strain. Or you could be under withholding and then you look at, man, I had all this money, I spent all this money because I thought I had it, and then I have this huge tax bill that I don't think about at the end of the year, and then you get in trouble with the IRS, and then you have taxes, I'm sorry, penalties and interest with that. So you just, the more that you can bring that amount to zero, the better. Because then you know exactly what you're working with throughout the year, and the IRS is already taken care of. One thing that you can do too is I tell people, try and think of your budget in a 20-20-50-10 style. So 20% is going to go to taxes right off the top. If you're not withholding it, you need to be putting it into an account that you're going to pay for taxes later. 20% should go towards investing towards your future goals, retirement, health planning, long-term care planning, things of that nature. 50% is going to be your needs. It's going to be, I need to pay my rent or my mortgage. I need to pay for groceries, the light bill, the electric bill, the water bill, things of that nature, clothing, and then 10% would be wants. Now you can move within that scope, maybe 15% investing, 15% wants, or if you can bring your needs down to 45%, then you have more time to, or more money to spend kind of throughout the year. But again, it all comes to cash flow management. You also, when you split, you have debts that you need to think about. You might think about refinancing them to a lower interest rate, help get the payment down a little bit, or even work towards paying those debts off. So that way you have more cash to work with throughout the year.
Renee, I was going to ask you, I'm a litigation attorney, right? And so when I have a client that's going through the divorce process, and you have a client that walks through your door and says, "Hey, I have a divorce lawyer. I'm going through the divorce. Can we work together?" How do you handle that? For example, when a client says, "Well, my divorce lawyers said something different about who can claim the kids on taxes." How do you navigate that?
That's so I try and I put my clients kind of at the center. I consider myself a financial director. So I'm like the quarterback, right? And so when it comes to finances, I'm going to be talking with their divorce lawyer. I'm going to be talking with their family attorney. I'm going to be talking with their estate planning attorney. I'm going to be talking with their CPA, because everything that we do affects everybody else, right? And so it's trying to come to the best outcome for the client that we possibly can. So if you have one divorce attorney that is saying something other than what I am, I'm not an attorney myself, so there might be some law that I was not aware of, and so I would, reach out to that attorney and just kind of have a chat with them and say, hey, this is kind of where I was leading the client. I think you had mentioned this, either
Mhm.
why did you mention this, or what's the outcome that we're trying to achieve, and just having that collaboration, I
Right.
think is very, very helpful.
Absolutely. From our perspective as the attorney, navigating them through the divorce, we have language that we include in our divorce decrees. I'm sure you've probably seen it before, where it says, disclaimer, I am not a tax expert. It's called indemnification clauses.
Hmm.
And so therefore I would defer to you. And so it would be such an asset in my cases to be able to have access to you, Renee, and be like, hey, I think this is what, the judge is likely to order, what from a tax perspective is my client likely to expect, and to stay within the bounds, obviously, of that law. So being a team for our clients and our listeners would really be the best of both worlds. And I wish all my cases had it, really.
Well, and I leave myself open to collaboration too, right? I have other professionals that contact me in regards to, well, what does this retirement plan look like if I'm trying to set it up for my client? They may not even be my client. I'm helping that particular professional
Mhm.
with their clients type thing. So if we can have mutual clients, that's ideal. But I'm also, I offer myself as a sounding board when it comes to things like that to other professionals.
Do you have so if a client comes in and it right out of the gate says, I'm going through a divorce, or I'm about to file, I've already hired counsel, or I'm looking at counsel, do you have a certain checklist that you go over with them or provide to them to say, hey, good that you came to me before launching this really complicated process. These are some things to consider, your tax exemptions, your listed beneficiaries. Do you have that kind of, or is it just all off the top of your head because you're so familiar with it?
Kind of both. I do like a structured approach to things. So I tell everybody I'm a financial GPS. If you tell me where you are and where you're going, then I can give you the turn by turn directions of what to do, how to get there, right? And so it's helpful when somebody comes pre-divorce because then we can talk it all through and we can talk, here's what your income is. So here's what your tax bracket's going to look like. Here's the accounts that you have. And if you're splitting them, here's probably what it's going to look like. Even if you have a business, what does it look like to divide business interests or to buy out a spouse when you have a business owner involved? And so, I look at it as the fact of here's exactly where we are right now. Here's what your budget's going to look like and change to. And then we start doing all the different aspects of planning. So, what does taxation look like now? What does the estate plan have to look like now? And how's that going to change? Because you had your spouse as a power of attorney, now you can't have your spouse as that power of attorney anymore. You probably wouldn't want your spouse making medical decisions for you in that sense, right? They might pull the plug immediately, type thing. But
You never know.
um, but it's also, if you have kids and you still want to do education, what are the tax credits? What is the education going to look like? How are both spouses, going to help? And so I can give them kind of preliminary idea of here's how life is going to change for you. And then as we're going through that split, again, it's working with that professional to see, well, what's on the table and what's not on the table. Right. And exactly how are things going to be split. And so as I get more information, then I can be like, hey, now that we know this is how your tax situation is going to be. This is how, your money situation is going to be. When it's all said and done, then I start looking at, okay, how do we get you solvent right now to out of survival mode, right? How do we get you back within emergency funds, getting you through a cash flowing budget to where you have money left over to do things? And now let's start working again towards your future goals of retirement and things like that, right? Education goals. And I can take it one piece at a time, or I can take it all at once, depending on how the client, how ready they are to kind of do that process. Because
What
it is an intensive process. It's changing your entire life from together to now on your own again type
Absolutely, and
thing.
I like that phrase that you use, financial GPS, really to help people feel, if nothing else, while they understand the process or try to grapple with it, feel like, okay, I got a plan, I have a roadmap, I have some version of a GPS of where it is I want to be and the path to get there. And like I was, saying earlier, and using all of us members of their divorce team, right? Tax experts like yourselves and financial advisors and the legal team. Do you treat, I was thinking as you were talking about how we're talking about the individual, right? The person dealing with how am I going to handle child support or changing beneficiaries and tax implications, and even spousal support. But what about a business owner? Let's say a couple started a business together, and one of them walks into your office and says, "What do I do with the taxes of the business? Do I handle it separate than my personal taxes?" What's your first thought process when someone brings that problem to you?
So my first thought process is okay, because I work with the total household and then I work backwards, right? So
Mhm.
total household income would be a certain level. Of that level, the business is going to have a certain amount of income coming in. And so the business structure has a certain, all to do with as to what is should be taxable or what tax savings do we have with the business. When and correct me if I'm wrong, but when we're looking at a divorce, they take the valuation of the business into account in the total household. And so the business may be split and you may have to buy out like a partnership of the spouse, or you use other assets to kind of buy out the spouse. The that one business owner gets to keep the business and keeps on working in the business. Is that kind of the way it works?
Right. Yeah. I mean, it can get pretty complex as you as you've seen, right? But there's a future valuation of the business. And so most of the time it's easier for us to say, hey, this is the current value of something. It's considered in the entirety of the community estate, right? And we can buy you out today. And of course the other party might say, well, wait a minute, what if it's valued at 15 times that next month because I know you're about to sell it or something. So certainly a thousand layers of issues can come in to
Yep.
that equation. But yes, it's considered generally part of the community estate, and we work backwards with it as well.
Renee, this is like your busy time, and we're your time is so valuable and limited. And so we really appreciate you taking time to speak with us. And I feel like we just kind of scratched the surface on what are some of the
Right.
best practices on what we can do as far as helping guide our clients through this process. If someone wants to get a hold of you, what's the best way?
So the best way is they can reach out to me by phone, by email. Phone number is 210-376-1746. Email is Renee at freedomwealthllc.com. They can also go to our website. They can, schedule a consultation there. I do offer free consultations. And so I want to learn more about them, have them learn about me, and then see if we can be a good fit, if I can provide help in some shape, form, or fashion.
Well, thank you. And thank you for those who are tuning in. And thank you, Valerie, for joining us. And please don't
Of
forget
course.
to like and subscribe and keep those 5-star reviews coming forward. Thank you.